All right, conversation about the 4% spending rule goes hand in hand with talk about annuities and life insurance products. The people selling these products claim, I hear them all the time claiming that the 4% spending rule doesn't work anymore. And what better way to put the 4% rule to the test than to see how it held up over the last 20 years, starting right before the dot-com crash and the Great Recession. But before I get to that, let's review what is the 4% rule. If you want your money to last 30 years, to produce income for 30 years, you take out 4% per year, and there's a very, very high likelihood that you won't run out of money. And by the way, that's 4% of income that increases with the rate of inflation each year, growing and growing. That's very important to understand. The back testing they did to come up with this 4% figure accounts for increasing income, not fixed income like annuities typically pay out. If you have a $100,000 nest egg of bond and stock index funds, you're not taking out $4,000 this year, $4,000 next year, $4,000 the year after that. That's right. This is the first sleight of hand that they use when they tell you about some annuity that pays 6%. That 6% they are paying is fixed. Your traditional bond and stock 4% income is not fixed. Very important to understand that. The other sleight of hand that annuity salesmen use to attack the 4% rule is to assume that you're paying some asset manager, like 1% per year, and you're investing in expensive mutual funds. You don't do that either. You buy index funds, and you don't pay some asset manager to hold your hand while you invest. Also, the 4% withdrawal rate assumes a 30-year time horizon. However, if you have just a 20-year time horizon, the safe withdrawal rate then increases to 5.1 to 5.5%, depending on which study you choose to believe. Also, another thing to keep in mind, if you have equity in your home you can tap into one day and are okay with tapping into it, then you can be even less concerned with the 4% rule and running out of money. And finally, the big elephant in the room, you've got some annuity salesmen telling you that the 4% rule is broken, it doesn't work anymore because bond yields have gotten so low. But at the same time, insurance companies invest about 70% in bonds on average. And by attacking traditional investing, they're inherently suggesting that lower bond returns is a problem for me, but not a problem for them? How the hell is that possible? What alternate universe are you investing in? If you're telling me that my traditional investing money is going to run out if I take out more than 4% per year, and yet you're supposedly going to keep paying me more, well, they're full of crap. They are going to have to pay out less later on. They'll tease you with that initial higher rate of income, but just as if you were to violate the 4% safe withdrawal rule in your early years by taking out too much, you would have to make up for it in your later years by taking out less. And actually, you would have to greatly reduce your income later because saving money in your early years makes a huge difference later in life because the money you save gets to grow and compound because you didn't spend it early on. Which is exactly what insurance companies are doing when they start off paying you 5.5% or 6% instead of 4%. They're digging themselves into a hole early, and they know it. They're not a bunch of math idiots. They adjust for it later, usually by simply making those payments be a fixed dollar amount each year. So 2000 to 2020, tough times if you entered retirement in 2000, but has now been 20 years. How much could you have safely taken out? Well, if you had a 50-50 portfolio of index funds, I'd say that with 10 years left to go, you could have safely taken out not 4%, not 3% like those annuity salesmen claim, but I'd say maybe about 4.9%. I'd be happy with $71,000 left going to work for me with just 10 years left to go. And just as a continued stress test, if from 2020 onward we were to repeat the dot-com crash and the Great Recession all over again, and in fact, you could have continued taking out 4.9% and not run out of money. And again, by making 2000 as our starting point, we're trying really hard to make the 4% rule look its worst. Chances are you're not going to begin retirement at the worst possible starting point. So if we were to make January 1998 our starting point, you could have safely taken out about 5.9% and been in great shape not to run out of money after 20 years. So this illustrates that these product-pushing salesmen are data mining, that they're cherry-picking starting dates in order to make traditional investing and the 4% rule look unsustainable. They're liars. With history as our guide, if you have a 30-year time horizon, you're likely very safe taking out 4% per year pegged to inflation. And if you have to take out more, you're probably going to survive just fine taking out 5% or more.